Hi there, I'm Jason Ayers, founder and president of OptionSource.net, and thank you for joining us to explore why an investor would use options. To understand why options would be incorporated into a portfolio, we need to first understand the psychological obstacles faced by many investors. It is human nature to be overconfident in market predictions. The more time and effort that is put into an investment opinion, the more the investor is convinced of its accuracy. In most cases, this leads to many investors overestimating their probabilities of being right. When an investor overestimates the probability of being right, they generally underestimate the risk. Pride of opinion becomes the investor's worst enemy. The average investor is under the illusion of being in control until having to make a decision to cut losses on a losing position, which is often difficult to accept. Knowing these obstacles, the investor who learns about options will learn how to protect their capital, generate consistent cash flow, and commit to an investment view using leverage while quantifying the risk. There are many myths about the options market, the first of which is that they are difficult to learn. The reality is that professional traders can use options in complex combinations to meet specific objectives. However, it is important to understand that these combinations are built on the basics. With some time and effort, an investor can develop an understanding of the options market sufficient enough to incorporate many simple yet powerful strategies into their portfolios. The next myth is that options are risky. The reality is that when used haphazardly, an investor can over-leverage themselves on an investment that is confined by time. When used responsibly, options can reduce the volatility of an investment, quantify risk, and generate cash flow in a portfolio. Another misconception is that investors always lose money to professional traders when using options. The reality is that an investor has the ability to take either the sell side or the buy side of an options trade. The option itself is priced based on the volatility risk of the underlying stock. As long as the investor has a proper understanding of the options market and applies the appropriate strategies and risk management principles based on their objectives, options can be a very effective tool. Many people are also led to believe that options are a great way to get rich fast. Incorporating them into an investment approach does not guarantee overnight success. However, when used correctly, there are many option strategies designed to enhance investment results. Another misconception is that trading stocks is safer than trading options. There is no denying that there are more variables to learn with options trading, but that doesn't necessarily mean that there is more risk. The risk on holding an individual stock is unquantifiable. To the average investor, the only accepted method to reduce the risk in a portfolio containing only stock is through diversification. Alternatively, when options are incorporated into a portfolio and used correctly, they help to manage and quantify risk even in concentrated stock positions. To summarize, an investor who commits to learning how to use options will have increased flexibility to manage a portfolio, be able to define and quantify risk, generate consistent income on their investments, and will have many alternative strategies beyond the traditional buy and hold approach to implement under various market conditions.